Taxes are one of the few certainties in investing, yet they are consistently treated as an afterthought. Many investors spend enormous energy selecting assets, timing entries, and optimizing strategies only to give back a meaningful portion of their returns through poor tax decisions. This is not because taxes are unusually complex, but because they are psychologically unappealing. Taxes feel like a penalty on success, something to be dealt with later, preferably by someone else. In reality, tax implications are not a side issue. They are a structural force that shapes net returns just as powerfully as risk fees and compounding. The first mindset shift every investor needs is understanding that pre-tax returns are not what you get to keep. What matters is after-tax return. Two investors can earn the same gross return and end up with very different outcomes, depending on how, where, and when those returns are realized. Ignoring taxes does not make them smaller. It only makes them less visible until damage is already done. Smart investing is not about avoiding taxes entirely, which is neither realistic nor legal. It is about managing them intentionally. One of the most important distinctions is between capital gains and ordinary income. In many tax systems, income earned from wages interest or short-term trading is taxed at higher rates than long-term capital gains. This creates a powerful incentive to align investing behavior with longer holding periods. Frequent trading may feel productive, but it often converts potential long-term gains into heavily taxed short-term income. Over time, this tax drag compounds in the wrong direction, quietly eroding performance. The difference between short-term and long-term capital gains is especially critical. Assets held for shorter periods are typically taxed at higher rates, while those held beyond a defined threshold receive preferential treatment. This is not just a tax rule, it is a behavioral nudge built into the system. Investors who respect it allow compounding to work longer and lose less to friction. Those who ignore it must overcome a tax headwind year after year just to break even with more patient peers. Dividends introduce another layer. Qualified dividends may be taxed at favorable rates, while non-qualified dividends are taxed as ordinary income. The type of dividend, the holding period, and the account in which the asset is held all matter. High dividend strategies that look attractive on paper can be surprisingly inefficient in taxable accounts. Understanding this distinction helps investors place income-producing assets where they do the least damage. Taxes also interact with turnover and strategy design. Strategies that generate frequent realized gains, even if profitable, can be tax inefficient. This does not mean such strategies are wrong, but it does mean they should be evaluated on an after-tax basis and often belong in tax-advantaged accounts. Investors who compare strategies without adjusting for taxes are comparing illusions, not realities. Another underappreciated concept is tax deferral. Paying tax later is often better than paying tax now, even if the rate is the same, because money retained can continue compounding. This is why tax-deferred accounts are so powerful over long horizons. Deferral is not avoidance, it is timing, and timing matters enormously in exponential systems like compounding. Losses, while painful, also have tax implications. Capital losses can often be used to offset gains, reducing overall tax liability. This practice, known as tax loss harvesting, turns volatility into a partial advantage. However, it must be executed carefully to avoid violating wash sale rules and unintentionally increasing risk. Losses should never be created solely for tax reasons, but when they occur, naturally ignoring their tax value is inefficient. Asset location is another silent driver of outcomes. Holding the same portfolio across different account types can produce very different after-tax results. Placing tax-inefficient assets in tax-advantaged accounts and tax-efficient assets in taxable accounts improves net returns without changing risk or expected pre-tax performance. This is one of the few areas in investing where optimization has little downside when done correctly. Behavior plays a major role here. Investors often make tax decisions reactively selling assets late in the year without a clear plan or avoiding necessary portfolio changes purely to delay taxes. This can lead to overconcentration and misalignment with goals. Taxes should inform decisions, not dominate them. Paying some tax to maintain a healthy portfolio is often far better than avoiding tax while allowing risk to drift dangerously. Perhaps the most costly mistake is treating taxes as a once-a-year event rather than a year-round consideration. Investment decisions made today determine tax outcomes months or years later. By the time tax season arrives, most choices are already locked in. Proactive awareness beats reactive scrambling every time. The reality is that tax rules change, individual circumstances differ, and no single strategy fits everyone. What remains constant is the principle after-tax returns are what count. Investors who integrate tax awareness into their overall strategy gain a durable edge, not by being aggressive, but by being intentional. As with most aspects of investing, the goal is not perfection, but alignment. Understanding how different types of investment income are taxed, how timing affects liability, and how account structure influences outcomes allows investors to make decisions with open eyes rather than expensive surprises. And once this foundation is clear, the next step is learning how to apply tax awareness in practice through account selection, asset placement, and behavioral discipline, which is exactly where we need to go next. By examining managing taxes in investing requires a practical and proactive mindset, because effective tax strategy does not come from last-minute tricks at the end of the year, but from a structure designed correctly from the beginning. The first step is choosing the right investment accounts for your goals. Taxable accounts, tax-deferred accounts, and tax-free accounts are not just legal categories. They shape behavior and long-term outcomes. Placing the wrong assets in the wrong accounts is like planting a strong tree in poor soil. It may survive at first, but its growth is quietly limited over time. The next principle is asset location, meaning placing investments according to their tax efficiency. Assets that generate frequent ordinary income, such as bonds, REITs, or short-term trading strategies, generally belong in tax-deferred accounts, where annual taxation does not erode returns. Assets that benefit from long holding periods and low turnover, where returns are primarily driven by price appreciation, are often better suited for taxable accounts. This approach does not change your overall asset allocation, but it can significantly improve after-tax results without increasing risk. Holding period discipline is one of the most powerful yet underappreciated tax tools. Extending holding periods not only reduces the tax rate applied to gains, but also lowers the frequency of decisions, which in turn reduces behavioral mistakes. Many investors focus on maximizing gross returns, while forgetting that taxes and behavior are often the strongest forces slowing long-term compounding. Respecting time solves both problems at once. Tax loss harvesting, when applied correctly, turns volatility into a partial advantage. Realizing losses to offset gains can reduce tax liability, but it must be done with care, avoiding trades made solely for tax reasons or violations such as wash sale rules. Taxes should never be the primary reason to buy or sell, but once an investment decision makes sense on its own, capturing the tax impact is a sign of sophistication rather than manipulation. A common mistake is delaying necessary portfolio adjustments purely to avoid taxes. This often leads to excessive concentration and misalignment with long-term goals. Taxes are a cost of progress, not the enemy of it. Paying a reasonable amount of tax to maintain a healthy, diversified portfolio is usually far better than avoiding tax while accepting unnecessary risk. Finally, taxes must be viewed as part of an integrated financial plan, not as isolated decisions. Current income, future income expectations, potential changes in tax law, and long-term objectives all influence what is optimal. What works today may not work 5 years from now. Periodic review and deliberate adjustment are far more effective than trying to design a single perfect structure that never changes. In the long run, successful investors are not those who avoid taxes most aggressively, but those who optimize after-tax outcomes most intelligently. They accept taxes as part of the system and design their strategies so taxes become a manageable friction rather than a silent leak that erodes results year after year. If this perspective helps you see taxes as a strategic component of investing rather than a burden to escape, consider subscribing to continue these long-form discussions focused on structure, discipline, and long-term thinking instead of short-term tricks, and feel free to leave a comment about where taxes currently have the biggest impact on your investing decisions, because awareness is often the first step toward lasting improvement.